Okay, my lovely friends, here we are. It is Sunday, February 6th, 2022. This is my newest segment of Markets Look Ahead. So let's get started, okay? Let's reflect a little bit as to what has been going on as of late, because I believe by looking back, we have a better perspective on what's going to happen moving forward. So look, it's no secret what's been happening to the debt market, the 10-year yield more specifically over the past several weeks. Let's talk about that. I have explained to all of you for a while now that the market is pricing in a Fed rate hike. How do we know that's true? Or is Greg just making this up out of like thin air, kind of like the Federal Reserve, how they create cash out of thin air? No. There are always telltale signs as to what is going on if you just know where to look. Okay. If you have observed action in the 10-year yield, why the 10-year yield? People ask me that all the time because the 10-year yield is the benchmark. It's the one everybody watches, okay? And it's just a critical piece of information that we can gather by observing simply the 10-year freaking yield. Okay, so what's been going on? The market has been, in my view, again, pricing in a rate hike for a while. We've watched the 10-year yield rise. On the back of that, we have seen the stock market fall under some pressure. Okay, these things work. It is a very, very close relationship with the 10-year yield and the stock market. They're not in lockstep, but they're very close, okay? I've covered this before a million times. So anyway, on the back of the 10-year yield rising over the past several weeks, and last week, well, that was epic. We'll talk about that in a moment. We've seen the stock market fall under pressure, more specifically the tech sector. I have covered again a million times how tech stocks are very rate sensitive. So we have seen an overreaction, and I covered this to the point of nauseum with regard to the tech sector. I told you we witnessed an overreaction and there was a buying opportunity there, and that has played out to be exactly right. This is not rocket science, people. Okay, so on the back of this market pricing in a rate hike, March is my target. Yes, I was wrong about the last one. Okay, I know a lot of you like to hear me admit when I am wrong. I am not right all the time. Okay, I think you all know that. But for the most part, well, you tell me. Okay, so with that said, we have this overreaction in the tech sector, which has been amazing, an amazing opportunity to get in here cheap. We've also witnessed a nice drop with the banks, which I've been buying for a long time. I've been advocating for my Lions to buy for a very, very long time. This has been a gift to all of us, and I think my Lions out here would agree. And you know which banks these are. I've been telling you. I've been putting this out in my free newsletter. Link in the description of this video. So if you have not yet subscribed, what are you freaking waiting for? Okay, it's free. I'm not kidding. All right. Anyway, with that said, so again, this movement here in the 10-year yield has obviously been reflected in the movement of the stock market. The Fed didn't do anything with the federal funds rate or raising rates. And what did that do? That initially hit the stock market. I mean, duh. We all knew that was coming. And it has rebounded since the market's now going, hold on a minute now. The economy is cratering. I mean, clearly, we'll talk more about that in a moment. It's not going to stop. Net every freaking month, we are losing jobs. But you said, I'm not supposed to know that. You see, the propaganda ministry has been paid to lie to you. Okay, whatever. We still know what the opportunities are, period, the freaking end. Last week, we watched the 10-year yield spike, and I told you that was a yellow flag. That yellow flag is not gone. It's still there. The 10-year yield right now is sitting at 1.91. Moving into next week, tomorrow, we are going to see if this yellow flag turns red. And the market will reflect that, people. Period. The end. Okay, very, very simple. So keep your eye on that 10-year yield. I will tell you every day. Believe me, I will be watching the yield curve, the 10-year yield, the MMRI, which you can watch yourself on my website, traderschoice.net. Again, link in the lovely description of this video. And it has moved up substantially. Now, look, let's talk about that real quick. When we're looking at risk in the market, it's a double-edged sword. The more risk there is, well, the more potential gains we can make, also potential losses. So we just have to sit back here and assess the entire situation. We can't just look in one spot. Again, that's what makes what I do complicated, all right? It's like a balancing act. I put together an incredible amount of information, all right? I assimilate it. I then come up with what I believe are the most likely scenarios. And for the most part, again, I'll let you all be the judge. How have I done with this? Well, pretty damn good, huh? Okay. Anyway, I'm just, look, again, not tooting my own horn. This is our thing, not just Greg Mannarino's. And I feel a sincere responsibility to all of you to at least get it right the vast majority of the time. And I think I do that. All right, so anyway, look, like I said, we are not out of the woods here. We need to watch that 10-year yield. I can't stress that enough. We need to watch the MMRI. More risk could potentially mean more reward. Could also mean potentially more losses. But again, we're gonna figure this out as we move forward. So anyway, let us move forward here with what's happening so we can best gauge what we should be doing. Let me just say this while we're out here. I believe the market, this is the most likely scenario moving into next week. I believe that without an outlying event, we should see the 10-year yield at least stabilize. What does that mean? If the 10-year yield stabilizes even where it is, the stock market's going higher. All right. If we see the 10-year yield knee-jerk higher, well, that's not good. The market's not going to like it. If the 10-year yield drops a little bit and the Dixie or the relative strength of the dollar comes down, that's very good. That's very, very good for the stock market. Okay, but let's forget the stock market for a minute and let us, again, move forward to a few things here. I've explained to you, and I made I said something wrong the other day. I had said that, well, actually it's not wrong, but the context was kind of out of place. I have been saying to you that right now, coming right at us from every single direction is another wave, a tsunami of inflation. I used debt the other day, but that's coming too. I mean, so it wasn't really wrong. If you believe that we have seen, peak debt, well, you're out of your freaking mind. We aren't even close to peak debt, which means we're not even close to peak inflation. So these things do play right into each other. Central banks have gone wild in their mission here to own it all. And you all know that. So anyway, yes, I said actually a super tsunami of inflation is coming at us from every direction. And it's not by accident, number one, and it's unstoppable. There's no way to stop it, nor does a central bank, especially the Fed, want to stop it. Again, what have I said to you since time immemorial? Central banks want to inflate, and then inflate some more. The more a central bank, any central bank, is allowed to inflate or called upon to inflate or called upon to weaken the currency or called upon to push rates negative, well, the stronger they become. The stronger they become. This concept seems to have gotten lost with a lot of people. And they don't understand what's going on. They don't understand they have no representation. I don't care what puppet they put sitting behind the Resolute desk. It doesn't matter. Our last president, Trump, the one that a lot of people like to lick his feet. A lot of people like to lick the current president's feet too, President Retard. But he was calling for a weaker dollar. He, Trump, was calling for negative rates. What would that do? That would make central banks, the Fed, even stronger. So you think that guy worked for you too? Doesn't matter who they put in there. Your vote don't count. If you think it does, well, wow, nothing is what it seems to be. Let us move forward here, people. At the beginning of this year, one of my top 5 trends was food and energy inflation. This has gone out of control. And I want you to be aware of this. It's not going to stop. There's no stopping it. It's going to get monumentally worse. And look, what are we seeing on the back of that? I've explained to you, and I hope this isn't you. I really do. But unfortunately, it probably is. We are seeing a credit explosion occur here in the United States. Citizens, mostly members of the middle class, or whoever's left here, are borrowing beyond their eyeballs. Credit card applications have hit a record high. These are people trying to claw themselves up out of a hole, but all they're doing is making the hole deeper. I've covered this over and over again. Stop borrowing. Stop it, okay? Learn to either cut bills or live more within your means. Otherwise, you're just going to fall to the lower rung of society even faster. I mean, that's what's in effect here. The creation of a new 2-tier society, a feudal system, period, the end. And look, I understand that a lot of you need to or want to maintain the illusion of that middle class lifestyle. But most of you have already probably fallen to the lower rung and you're going down unless you make some monumental changes. And I think, again, with the pace of inflation rising right now by design, it's very, very difficult. They want to create a slave society. That's really what's behind this entire thing. Why do you think the Fed has been printing cash out of thin air, creating debt out of thin air, buying assets since the last meltdown here? Do you think the last meltdown was really by accident too? Honestly, you really do? Nothing that happens in these markets is by accident ever. And we're all leading up to a grand finale. All right, people, like I said, consumer borrowing, credit cards at its fastest pace ever. The economy continues to free fall. You all know that here. Real wages cratering at their fastest pace in history. Do you think that's going to stop? Honestly, really? The Fed is going to continue to inflate. We all know that, despite the fact that our economy is booming. Oh, you know it is because they're saying it is. The propaganda ministry keeps telling you how great our economy is this morning. They had Larry Summers out on, former Treasury Secretary, out on Bloomberg, trying to convince you, if you were watching this, how strong our economy is. You see, you have to realize something. You see, they're put out here to distract you, to mislead you, and to propagandize you. But you're a lot smarter than that. And I don't think most of you watch that shit. It's all dog shit anyway. You can rest assured, people, that easy money from the Fed is not going to stop. And that will push the stock market higher. I still say we need to watch that 10-year yield this week. This week is going to be huge. Huge week to see, is this yellow flag going to turn red? That's going to be the theme of the week. And I want to hear from you. Do you believe we're going to see another spike in the 10-year yield? Or is it going to normalize? What's your take on this? Do you feel like we're at an inflection point? Or I believe that, again, the most likely scenario is this is going to normalize and the market's going to spray its shorts over it. That's my take on it. But what do I know? Going back real quick, I was writing this stuff down. This is just from this morning. I'm writing stuff down as I'm drinking my coffee. Look, I would be and I said this, I'm going to say it again, the same words, very afraid to see a pullback in energy because all that's going to do is set it up to go higher. Again, we have WTI crude, $91, $92 a barrel. If we get a pullback, and I think I hate to say due for one, it's going to set a new floor and it's going to go much higher. Up, floor, higher. And again, realizing, if you want to just look at crude oil, that over 6,000 products are made with crude oil. What does that mean for inflation? What does that mean for prices? It means people are going to borrow more just to make ends meet. Do you think, again, this whole thing, the way it ties together is by accident? No, you don't know. You know it's not. Anyway, people, so with that said, I think I have laid out the groundwork for you. What you should be looking at, what you should look for, understanding risk in the market, which is rising, but that's a double-edged sword. More risk, more reward. But at the same time, there's also the risk of more losses here. Look, we got this, you and me. We know what to do. We know why we're doing it, okay? I've been telling you guys for the longest time to be on the long side of this market, or the market going higher, owning large cap dividend paying stocks, trading around them using credit spreads and selling puts onto the market. So even in those times when you're in, let's say, a large cap company XYZ, even if it's just one, okay, which has been in a long-term uptrend, okay, this is another thing. Never go against the trend. You want to buck the trend, you're going to get hurt, okay? The easiest way to stay ahead of the market, beat the market, is to find companies, large cap companies. I love the banks. You know that. JP Morgan, Goldman Sachs, Bank of America, especially these three. And what people keep asking me, Greg, why these three? Why these three? Because in my opinion, okay, because looking at what's going on behind the scenes with these companies, with these banks, they're well positioned moving forward. So with that said, look, weaponize the system. Yeah, they're the enemy, but good. Let them pay you to own their stock, the dividend, okay? They're all in uptrends long term. So if you know that, staying along these institutions and trading around them, it's a beautiful situation. So even if the stock pulls back, if you're setting up your credit spreads correctly, which is not a hard thing to do, if you're selling puts way out of the money, 20%, you're still making money. You're still making money no matter what happens. This is not rocket science, people. I don't know another way to say it. Anyway, with that said, you need to be betting against the debt, hoarding precious metals, getting yourself in cryptocurrencies, which have been extremely volatile lately. Bitcoin now back over 41,000. Why do I refer to Bitcoin? Because it's the mommy. Mama. It's the one that, wherever Bitcoin goes, the other cryptos go as well. All right, people, look, that's it. Lovely, lovely Sunday. Markets a look ahead. I think you and I have a very good handle on what we're doing. We're really not going to deviate from our strategy. We're not going to deviate until that yellow flag in the 10-year yield turns red. And I'll tell you when that happens. And again, we got to put a lot of things together. We will not change our strategy. Okay? We're going to continue to buy the dips. We're going to look for a pullback in energy, which is really not a great thing. I told you. I am not looking forward to it because all it's going to do is set up a floor to go higher in this environment where central banks are going to continue to inflate. Do you think they're not going to? Really? Duh. No, I think you do. We got it. You and me. Good. Love you all. Please share the video. See you in the morning. And I hope I didn't forget anything. If I did, I'll remember in the morning. I'm out of here.